Hello and welcome to our discussion on the financial statements. Today we would like to address three related questions. Why EVA? What is EVA? And how is EVA calculated? EVA is required to address the limitations of the return on investment. Return on investment as a tool for evaluating the performance of a company has following limitations. These limitations are: one is called the financing anomaly, the other is called the accounting anomaly, financing anomaly and accounting anomaly. So whenever we calculate the return on investment, whatever is a form, return on equity or return on total assets or return on capital employed, since both this information come from the financial statements are GAAP based, assumed based numbers, so they have these anomalies. The financing anomaly is that the interest is treated as an expense, whereas the dividend is not. So therefore, in accounting, the sources of finance are treated differently. You don't see the cost of equity on the financial statements. So the weighted average cost of capital is conspicuous by very absence in the financial statements. So that is financing anomaly. The accounting anomalies arise due to the accounting assumptions which the GAAP provides relating to the following. Most of the common accounting assumptions which may become accounting anomalies are depreciation, cost of goods sold, amortisations, lease, deferred tax. So while preparing the financial statements for the shareholders, when you are guided by the generally accepted accounting principles, gives certain flexibility with respect to the treatment of depreciation, COGS, amortizations, lease and deferred taxes. So these assumptions sometimes it's possible that may make the financial statements not to reflect the economic reality. So balance sheet and the annual statement of operation, that is income statement, may not reflect the economic reality. So therefore these are called accounting anomalies, and EVA tries to address these two anomalies, and we'll see how these limitations are addressed by EVA. But what is this EVA? EVA is the excess of NOPAT, net operating profit after tax but before interest, over the capital charge. NOPAT can also be called as an adjusted PAT or adjusted profit of an unlevered firm. So NOPAT is an adjusted profit. Okay, we'll see why it is called adjusted profit of an unlevered firm. That means we remove the leverage while computing the NOPAT to keep aside or remove the financing distortion or financing anomaly. So NOPAT is calculated as PAT plus interest into 1 minus T and plus minus accounting adjustments. These accounting adjustments are required to address the accounting anomaly, and interest into 1 minus t is adjusted to remove the financing anomaly. So the NOPAT calculation takes care of the financing anomaly and the accounting anomaly. And the EVA calculation, for EVA calculation we need the balance sheet, we need the income statement, we need the cost of equity, we need cost of debt, we need to understand the accounting adjustments wherever required. In order to understand the accounting adjustment, we have to see the accounting policies and then examine whether they fail to reflect the reality. If yes, then do the accounting adjustments. If no, then you don't need an accounting adjustments. Let us take an example to do that. Suppose this balance sheet is given for a particular year at the end of the year, and this balance sheet shows certain assets and sources, and the sources are equity, the long 10% bonds, creditor, 12% short-term liabilities, and plant, R&D after amortization, stock and cash. An income statement gives us profit after tax of 15,190. So first step, let us calculate the PAT, NOPAT, by using the PAT. So PAT plus the accounting plus interest into the adjusted interest, that is interest into 1 minus t, that is into 70%. So 2110. So it is I into 1 minus t. Let me write down that 1 minus t. Then you have accounting adjustments. Accounting adjustments. The accounting adjustments in this example, or in this case, I have two accounting adjustments. One is depreciation for EVA is assumed 7,000, whereas we are charged depreciation 10,000. So add back excess depreciation, that is 10,000 minus 7,000. We add back 3,000. It also says there is no amortization of R&D, so therefore amortization is also removed. So entire amortization is added back. As a result, you have the NOPAT, the net operating profit after tax, is 15,190 plus 2,310 plus 3,000 plus 15,000. So it is 35,500 is the profit of an unlevered firm, or rather adjusted profit of an unlevered firm. Unlevered firm because we have removed the effect of the leverage, but we are not going to ignore it. We take that under the capital charge. So NOPAT is 35,500, which is calculated by taking interest and the accounting adjustments. But before we calculate the capital charge, let us write down here the capital charge. Capital charge is equal to capital adjusted capital employed into WACC, and adjusted capital employed. So adjusted capital employed is equity plus long-term debt plus interest bearing current liabilities and plus minus accounting adjustments. The accounting adjustments, which are given a name called equity equivalent. That means these adjustments are called the accounting adjustments which are required to convert the accounting profit into economic profit are called the equity equivalents. So let us go back to this. So let us prepare the economic balance sheet. So the economic balance sheet will also have the same assets. So I put there here. But the value of these assets, plant will not be 100,000. Plant will be 103,000 because you have charged less depreciation. R&D will not be 15,000, but R&D will be 30,000 because there is no amortization and no impairment. No amortization and no impairment. So suppose I make it 0, so therefore it is 15,000 plus 15,000 minus impairment. So therefore R&D in the economic balance sheet will be 30,000. 15,000 plus 15,000 minus the impairment. Stock, no adjustments done, and cash, no adjustment. So the total of the adjusted balance sheet or economic balance sheet is 168, whereas the accounting balance sheet is 150. So equity, the sources of the on the balance sheet are equity, the long-term bonds, creditor, the creditor, and the short-term liabilities. Short-term liabilities 15,000. So the balance sheet of the is not tallying. The balancing figure is called equity equivalent. Equity equivalent, as I mentioned here, is a adjustment for, okay, is a adjustment show, okay, adjusted is the accounting adjustments required to convert the accounting balance sheet into economic balance sheet. And that is, what are those adjustments? We have taken 15,000 and 3,000 respectively. So you have the economic balance sheet in place. Now with this economic balance sheet we calculate the capital charge. So the capital charge will be on equity, on equity equivalent, on the long-term debts, on the interest-bearing current liabilities, and for this we have given capital employed, the cost of equity given here. The cost of the debt depends on the coupon rate of the bonds, so therefore I into 1 minus T, so therefore 7%. And in the same way, this is also the equity equivalent is also cost will be cost of equity. The cost of long-term debts will be 7% because it is cost of debt is equal to I into 1 minus T, and cost of short-term debt once again 0.70 into 12%, so which is 8.4%. So therefore the capital charge will be 30,600, 1,050, 1,260, so 28,910. So EVA is equal to NOPAT minus the capital charge. So the NOPAT is 35,500 minus 29,000. So therefore 6,590 is a economic value added for this particular business, which is the excess of the capital net operating profit after tax over the capital charge. And the capital charge is 28,000. The capital charge is 28,910. But a few things that I would like you to have a look at is the concept of the accounting adjustments. In this case, the accounting adjustments are equal to the accounting adjustments relate to these depreciation and amortization, which is equal to the equity equivalent. So accounting adjustments while computing the profit is the accounting adjustments for the period, and where the balance sheet there is the accounting adjustments up to the period, or a cumulative accounting adjustment. But since this is for the first year we are calculating, so therefore the accounting adjustments in the balance sheet is equal to the accounting adjustments in the income statement, or adjustments to the NOPAT. But the adjustments here are with respect to amortization and impairment. Suppose we change this and make a change in our assumptions. We copy this, and then we say that the accounting adjustments differ. Okay, so, and we say that there is an impairment there. Suppose impairment of R&D, instead of saying no impairment, if we say that R&D impairment, okay, in other words, if the market value of R&D is given, if the market value of R&D is given, then that means there will be an impairment. If the market value of R&D is given as 28,000, okay, if market value of R&D is given as 28,000, we added back amortization, but there is a need for impairment, okay, because the R&D has impaired to the extent of 2,000. So minus 2,000 is the impairment of the R&D. So that has to be shown in the adjustments for converting the accounting profit into NOPAT. So the NOPAT will be not same as the previous one. The NOPAT comes to 33,500. Observe that. Whereas, let me remove this, whereas delete, whereas here the NOPAT was 35,500, and in the balance sheet you can see the equity equivalent will be now not 18,000 but will be 16,000, because the equity equivalent are the adjustments, and the adjustments are depreciation, amortization, and the impairment. Because in the income statement we have not shown the impairment, but in the NOPAT we are showing the adjustment for the impairment too. If the income statement, if there would have been an impairment, then of course there is no need of making that adjustment. But here there was no impairment, so for computing EVA we are doing the impairment. So the equity equivalent changes here to 16,000. In the previous case, equity equivalent is 18,000. Because of that, the NOPAT has changed, and because of that, equity equivalent has changed. Because of that, the capital charge has changed, so EVA has changed. So to recap, so EVA is an adjusted profit, adjusted for the financing anomalies, an adjustment for accounting. But when we see this, we have just removed the interest from the income statement, taken to the capital charge. So we are not ignoring interest, but we are removing interest from the profit and putting this both under the capital charge, and the capital charge includes both the cost of equity and the cost of the debt. So the weighted average cost of capital, if we are interested to find the WACC will be 28,500 divided by 1. So WACC is 17.7% here, and in the previous case WACC will be, the WACC will be slightly higher. WACC will be slightly higher. Okay, so WACC will be 28,000 divided by okay, so 17.7% is the WACC. So this WACC is to understand that whether the business is generating sufficient profit or not. So we can also find EVA by saying that it is the return on capital employed minus the WACC, return on capital employed minus the WACC into capital employed, and the return that you got, which is 35,000 divided by this, so 21% is the return on economic capital employed. So EVA is 27.78 minus 17.7 into the capital employed, so 6,590 is the EVA. So you can calculate EVA either by finding the capital charge and the WACC, or we can find EVA by calculating NOPAT minus the capital charge. Thank you very much.